Hello guys, welcome back with me. Don't forget to like, comment, share, and subscribe. Crypto traders love to ape and make decisions. Investment using high leverage in futures markets. But most traders fall victim to these three key mistakes. Airdrops can also cause discounted futures prices since the holders of a derivatives contract will not receive the reward. But that's not the only cause behind a decoupling, since each exchange has its own pricing mechanism and risk. For example, Polkadot quarterly futures on Binance and OKX have been trading at a discount versus DOT price on spot exchange. Many traders frequently express some relatively reminiscent about trading cryptocurrency futures, especially on derivatives exchanges outside the realm of traditional finance. The most common mistake involve futures markets price decoupling, fees, and the impact of liquidation on the derivatives instrument. Let's explore three simple mistakes and misconceptions that traders should avoid when trading crypto futures. Derivatives contracts differ from spot trading and pricing and trading currently. The accurate futures open interest in the crypto market surpasses below and retail trades and experienced fund managers use this instrument to leverage their crypto position. Futures contracts and other derivatives are often used to reduce risk or increase exposure and are not really meant to be used for degenerate gambling. Despite these common interpretations, some differences in pricing and trading are usually missed in crypto derivatives contracts. For this reason, traders should at least consider these differences when venturing into future markets. Even well-versed derivatives investors from traditional, so it's important to understand the existing facilities before using leverage. Most crypto trading services do not use US dollar, even if they display USD quotes. This is a big untold secret and one of the pitfalls that additional risks and distorts when trading and analyzing futures markets. The pricing issue and the lack of transparency, so clients don't really know if the contracts are priced in stablecoin. However, this should not be major concern considering that there's always the intermediary risk when using counter-transit exchange. Discounted futures sometimes come with surprises, will not be awarded any of the potentially frequencies that other holders may risk. Notice how the futures contracts traded at the 4% discount between May and August. The backwardations demonstrates a lack of demand from leverage buyers. However, considering the long-lasting trend and the fact the Polkadot traded 40% from July, 12 external factors are likely in play. The futures contract price has displayed from spot exchange, so traders must adjust their targets and entry levels whenever using quarterly market. Higher fees and price decoupling should be considered. The core benefit of futures contracts is leverage, or the ability to trade amounts that are larger than the initial deposit. Let's consider a scenario where the investor deposits $100 and buys long $2,000 USD worth on Bitcoin futures using 20 leverage. Even though the trading fees on derivatives contracts are usually smaller than spot markets, a hypothetical fee applies to the trade. Therefore, entering and exiting the position a single time will cost, which is equivalent of the initial deposit that might not sound much, but such a toll like as the turnover increases. Even if traders you understand the additional costs and benefits of using a futures instrument, an unknown element tends to present itself only in a volatile market condition. A decoupling between the derivatives contracts and the regular spot exchange is usually caused by liquidations. When a trader's culture becomes inefficient to cover the risks, the derivatives exchange is a built-in mechanism that closes the position. This liquidation mechanism may cause drastic price action and consequent decoupling from the index price. Maybe that's all from me. Don't forget to like, comment, share, and subscribe. Thank you.